Stock splits are debatable no matter how you slice it on this tech edition of Industry Focus. Greetings, fools. Sean O'Reilly here at Fool Headquarters in Alexandria, Virginia. It is May 6, 2016, Friday, TGIF. And in studio with me to talk all things tech, as always, is Dylan Lewis. What's up, man?
Not too much, Sean. Nice to be back. We had a little break last week because I was hosting with Nathan on the show.
Yeah, how'd you do with the chair switch?
I sat in your chair, the host chair.
Was it weird?
And he sat over here.
Super
it was
weird.
different.
It was a good show, by the way.
Well, I realized that the camera was getting my right side rather than my left side.
Is that your better side?
I don't know. I guess you'd have to ask the viewers.
What do you... Write into us at industryfocus@fool.com to tell us which side is Dylan's good side.
There it is, the email plug. Now we can get on with the show.
So we're talking about not necessarily a tech theme today, but it obviously affects a couple of tech companies, which we'll be talking about. But we're talking about stock splits.
Mm-hmm.
So Dylan, for our listeners that may not know, what is a stock split?
Stock split is basically, if you think about a company's value and their ownership as a pie, stock splits are taking that pie and maybe it's cut into eighths, we'll say, to start, and then cutting it into sixteenths.
What kind of pie is it?
I like to think it's a pecan pie.
Pecan pie.
Pecan pie. So if you owned an eighth of that pie and it was a 2-for-1 split, you would be getting now 2 slices of 16ths pie, right?
Why do people do this, Dylan? No.
Yeah, I mean, there are a couple different reasons companies do it. Some of them I put credence in, some of them I don't personally. But the idea here is like you're making your shares slightly more accessible to the average investor. So because the overall value of the company doesn't change and you're just getting smaller slices. So say you're currently trading at $100 a share. They do a 2-for-1 split. They are now trading at $50 a share, right? And you have 2 shares in your account.
What is your opinion on that? Because obviously, and everybody's favorite example of this is, of course, Warren Buffett's Berkshire Hathaway. Not everybody has a $200,000 to just buy 1 share of something. Do you think that matters?
I think there's something to be said for keeping your share prices high and having people that are buying and holding and not moving in and out of positions. Right. I think it does attract a certain type of investor. I do think it's nice when companies decide that they want to make their shares more accessible to the average investor. You know, Tim Cook, when Apple split 7-for-1, said, we're taking this action to make Apple stock more accessible to a larger number of investors. Like, made it plain and simple. Like, this is part of the motivation for this. One of the other things people will cite is it does increase liquidity. If for whatever reason you're seeing really wide bid-ask spreads, so what people are willing to sell for versus what people are willing to buy for, and the brokerage accounts or the brokerage teams that pair those up, you'll see those spreads tighten up.
That seems like kind of a dubious claim in this, in today because of just the proliferation of technology in the financial industry.
Yeah.
All trading is done by algorithm now anyway. So
especially because most companies that are splitting, for the most part, already have a pretty big, daily active volume, and it's not something that's going to dramatically change that. So I don't know how much I believe that, but the last line of thinking, and again, this is one that is not super relevant maybe as much anymore, but board lot thinking and the strategy there. So a board lot is the standardized number of shares as defined by a stock exchange as like a trading unit. And so basically you think about some of these big institutional moves and brokerage moves that happen. The purpose of these board lots is to avoid odd amounts of shares. So if everyone is working in these 100-share denominations, typically, then you won't wind up with these weird 83-share lots that no one wants.
Right.
And so it makes it easier to get a collection of 100 shares for that board lot if the share price is lower.
Got it. Again, that just seems like that would have been more of a problem 30 years ago.
Right. Yeah. And so I think, and I actually have a great data point and some questions to ask that tie into that a little bit.
Okay.
So it's kind of an interesting data point I came across in researching the show. From 2008 to 2013, only 12 S&P 500 companies on average split their stocks each year. And this is data coming from S&P Dow Jones indices. By comparison, in the 90s, an average of 64 companies in the S&P 500 split their stocks each year. In 1997, there were 102 total stock splits.
Wow. So proof is in the pudding. I mean, yeah.
And so I have a couple theories as to why stock splits are going down. Before I name any of them, Sean, do you have any guesses or any thoughts yourself?
When I peeked at yours, they're very good. But the other theory that I have is the Warren Buffett has become a huge part of just the American nexus and everything. And he's become increasingly influential in the last 20 years. I mean, all these books, and he's just everywhere, and he's basically a household name now. And another instance where he kind of said this is silly was tech companies in the early 2000s, and actually Coca-Cola too, they weren't expensing stock options on their income statements. They were giving millions of dollars to employees, but they weren't expensing them on income statements. And Buffett was like, that's silly. It's hard to calculate the value, I'll grant you, and that's fine.
But you need to account for it somehow.
But you need to account for it somehow. And not only did Coca-Cola, which he owns 9% of, do it, and that was actually the first S&P 500 company to expense stock options, I believe. If it wasn't the first, it was one of them. But he actually got his buddy Bill Gates to do it at Microsoft. They were the first big tech companies. So I would throw... I couldn't prove it, but I would just throw out Buffett being part of the American nexus and his thoughts on the matter. He does not believe in share splitting. He wants long-term partner shareholders. I would throw that as a harebrained theory of mine.
Yeah. Okay, so a couple thoughts that I had on it. One of them, you look at the time frame that was cited, and I grabbed this from a Wall Street Journal article, but that 2008 to 2013 range, that's mid to post financial crisis, and so you might just see companies that are looking for...
They were doing reverse stock splits, more likely.
Yeah. You might just see companies wanting to stay stable and not really rock the boat with anything crazy on the corporate governance side. One of the other things, I think, to your point about technology, you have online discount brokers, which make building positions much cheaper.
Right.
And so... you look at some of the very expensive tech stocks right now, like like Google. If you want to buy one or two shares, right now you can do it and pay a $7 commission, and it's not the expenses are not a huge portion of the overall transaction.
Flat, so it doesn't matter.
Right.
Yeah.
Whereas maybe in the early 90s or so, the cost of making those types of trades and position building and dollar cost averaging was a little bit more expensive. The one other thing I think might be contributing, maybe not quite as much, is the widespread availability of fractional shares. And so the idea that people do not need to buy an entire share of Google. Right. There are a whole bunch of platforms out there where you can buy parts of a share of Google.
Wonders of modern technology.
Yeah. So those are some of the reasons I see. But I think largely companies are not they're not as tied up in the idea of making it as accessible to buy shares. And I think there's something to that idea of building more of this buy and hold holding company type approach. I mean, you see that's what Alphabet did, right?
Yeah.
I mean, that's kind of what they're moving towards, and there's a lot of Buffett influence there.
So when do you think investors should care about a stock split? Like, when will it affect their lives?
Yeah. So to go back to that metaphor of the pie's the same size, and you're just slicing it differently, and you're owning that same portion. Sometimes there are instances where it's not just...
One of the slices gets to vote a lot.
Basically, you wind up in these situations where we're slicing the pie differently, but I'm telling you what the pie is going to look like. Or I'm going to tell you what the pie is made out of.
One of the slices has all the pecans.
Yeah. And so you're seeing, I think, there are a couple of really high-profile examples. Under Armour, one of them, out of the tech space, but... some stock splits more recently have been used to issue new share classes, and those new share classes distribute the economic value of the split, but they don't necessarily have the same rights as the previous shares did. And our lead-in for the show and why we wanted to talk about this was Facebook's proposed split, and this is something that came up in their conference call. And so if you checked out Facebook's conference call, you would have heard, pending stockholder approval, we intend to issue 2 Class C shares as a one-time stock dividend for each outstanding Class A and Class B share, resulting in a tripling of the pre-classification total shares outstanding. And that's from David Wayner, the CFO of the company.
Who owns all those Class B shares, Dylan?
You want to take a guess?
Oh, I know who.
Yeah, so right now Facebook...
His name rhymes with Muckerberg.
Yeah. Facebook already has 2 classes of stock. They're A and B shares. And they were created when the company went public, and the idea there was they wanted Mark Zuckerberg to retain ownership of the company. So Class A shares, they each have 1 vote. Zuckerberg owns a pretty small percentage of them, actually. I think it's like about 4 million of the 2.3 billion outstanding. So tiny. Class B shares, on the other hand, have 10 votes each. He owns 468 million of the roughly 550 million outstanding.
Yeah.
So like 85%.
Yeah.
So all told, he owns about 15% of the company, but wields like 60% of the votes.
So this is automatic. The proposed, issuance of the 2 Class C shares and everything, pending stockholder approval, that's definitely going to happen because he controls 60% of the voting power of the company.
It will probably happen. Yeah, it'd be crazy for it not to, right?
Unless he accidentally hits the no button or something.
Yeah, and so how does this all tie in? Again, from the company's conference call, this structure will allow for the preservation of the voting structure that has served the company well to date, while allowing for Mark to fund the Chan Zuckerberg initiative over the course of his lifetime. Importantly, as part of this proposal, the preservation of the multi-class capital structure would generally be predicated on Mark continuing to maintain an active leadership role at Facebook. And so, for maybe listeners that don't know, the Chan Zuckerberg Initiative is Mark and Priscilla Chan, his wife's LLC, and it's not a nonprofit, but it is slanted towards a nonprofit type mission. The idea there is advancing human potential and promoting equality in areas such as health, education, scientific research, and energy. So
he's more or less doing what Gates did, just a little bit younger,
yes,
with the Bill and Melinda Gates Foundation.
Exactly. And so earlier in the year, they committed to donating 99% of their Facebook shares, the value of their Facebook shares. And he said, he's not going to sell more than $1 billion over the next 3 years. But for him to do that based on his current ownership, he'd hit a point where he'd be selling very valuable shares.
Right.
Right.
In terms of voting rights.
Yes, in terms of voting rights. And so if you look at this, what is effectively a 3-to-1 split, he will be receiving a ton of shares, over 900 million shares to work with. And he will then be able to transfer the non-voting shares, the Class C shares, to those
the foundation,
the LLC, and then maintain that ownership.
Got it.
And this is very similar to what Under Armour looked to do with their C shares, right? I mean, the idea there was Kevin Plank is at the helm, and he wants to maintain ownership of the company.
It seems like companies wind up doing stuff like this just so the founder can spend some of their money. You look at Larry Ellison over at Oracle. He owns one of the islands of Hawaii, and he races super crazy yachts. And
doesn't sound like he's given 99% of his shares away.
No, but it was interesting to me because I don't think he's ever really sold a single of his original shares in Oracle. But what he did, instead of like doing a different share class than selling shares or whatever, he just gets a ton of stock options every year.
Oh, he's written in crazy grants, right?
Yeah. So, and there's that, and then obviously you've got Buffett, who just waited till he was 80 to start giving his money away, and then it doesn't matter. And really the only outlier there is Gates that I can think of, because he's just selling his shares. He actually, it happened a year ago, I think. Ballmer actually owns more of Microsoft than Gates.
Wow.
Isn't that crazy? Like, imagine.
Yeah, I didn't know that.
Yeah, he was. I remember going to the library when I was like 16 and reading the Value on Investment Survey, and one of the pages in it is major insider sells, and they just send it out every month or whatever. Every month, like clockwork, for like 15 years, Gates has just been selling 20 million Microsoft shares. Anyway, so how do you... Bottom line, stuff like this always kind of leaves a bad taste in my mouth.
Yeah, there's that weird tinge of like, I know what you're doing, and I think it's right.
Right.
Because if you're a Facebook shareholder, you believe in Mark Zuckerberg,
right,
and you believe in his vision of the company, and you want him at the helm. I can't think of anyone else that you'd rather have running that company. So you want him locked up, and you want a corporate structure that gives him the opportunity to wield ownership as he sees fit and steer the company towards the initiatives that he wants to be working on. There's that.
On the other hand,
yeah, there's that weird taste to it, though. And if you own Facebook and you don't want Zuckerberg at the helm,
why are you buying?
Why do you own them? I guess.
It just seems to me like stuff like this, just complicated, convoluted ownership structures, long term, they kind of muck things up a little bit.
Yeah, and there's actually already been a class action lawsuit filed by a shareholder claiming basically this move gives Zuck.
Did that happen about 5 minutes after this announcement was made?
Yeah, it was like that. So they claim the move gives Zuck entrenched control without really him having to give up anything.
Right.
And that's kind of problematic. And from a corporate governance standpoint, I understand that argument, but it's really one of those things where if you believe in him as a leader and you're following him as an investor, then you really shouldn't worry all that much about it.
You also brought up a good point when we were walking down here. This also kind of protects them from crazy corporate raiders and stuff.
Yeah, I mean, if he
I appreciate
if
that.
he maintains more than half of the voting rights for the company, then he
Right.
can pretty much do whatever he wants. And so you're not going to have someone really vocal like Ackman or Icahn come in and tell him what he needs to do.
Right. And then they'll sell a year later because they don't actually care about the long-term company or something.
Yeah, and this is something they talked about a lot in the conference call was, we are making several long-term bets, and we feel like a lot of the big risks that we're taking, more of them are in front of us than behind us.
Right.
And having an entrenched CEO that is also someone that owns a ton of the company and can do what he needs to do sets you up to make some of those bets and make you, less subjected to these more short-term, medium-term mindsets that are out there. So people that are interested in following up on this, just stay tuned. There's going to be a vote in the annual shareholder meeting on June 20th, and that will determine whether or not it passes. I'm guessing it probably will, but more to come on that.
So to round things out here, when should we not care about stock splits?
Yeah,
Every other instance.
Basically, when none of the above applies,
Right.
like if it's not materially changing the corporate ownership structure, if you are simply getting 2 shares of the same share class for one that you owned before, then it's probably not much of a big deal, right? Reading financial media stuff, I'm sure you see this too, but I'll see things like Amazon should split its stock because it's expensive, and people should buy it.
Do you feel richer with a $10 bill or 2 5s?
Yeah. And you'll see the arguments that are like, well, psychologically, someone believes that an $100 stock could go to 200 much more easily than a $500 stock could go to 1,000. I'm like, well, but that's not how growth works. Like it's it's the same growth percentage either way. So I don't know. I would just ignore that kind of noise.
The only other time I could think of where it would matter was it was being done for a reason such as an acquisition. Berkshire Hathaway has a Class B shares that are 1/100th, I think. So they're traded for $2,000-$3,000, and then Class A is $200,000. And they were actually done so Berkshire Hathaway could buy American General Insurance. Anyway, they bought another insurance company in like 1999, and it was a stock for stock deal. And they're like, we can't chop up $100,000 share price, so they had to issue the Class B in order to make that possible.
Yeah, so that's when you need it.
But obviously, the event there is the merger, not the actual split. Because
Right.
Cool. All right, Dylan. But thanks for your thoughts.
Always a pleasure, Sean.
Have a good one. And if you're a loyal listener and have questions or comments, we would love to hear from you. Just email us at industryfocus@fool.com. Again, that is industryfocus@fool.com. And as always, people in this program may have interest in the stocks they talk about. The Motley Fool may have formal recommendations for or against those stocks, so don't buy or sell anything based solely on what you hear in this program. For Dylan Lewis, I am Sean O'Reilly. Thanks for listening, and Fool on.